So we like to use these videos where we can to explain a little bit about the jargon and the lingo. So let's just talk about non-rated bonds. Firstly, what that means, and then how, again, you're inputting that opportunity set into the fund.
Yeah, well, obviously there are three main public credit rating agencies: Moody's, S&P, Fitch.
And they give a rating based on the quality of your company, the likelihood of you going bust, and being able to pay your coupon.
Exactly. And
AAA being the highest.
Yeah, and then the cut-off being BBB minus, and then everything below BBB minus is a high yield company. Irrespective of the yield, by the way, which obviously people get confused, is to do with the rating as opposed to the underlying yield. There is a subset of the market that, for whatever reason, does not carry one of those public credit ratings. It may be that
they cost, apart from anything else.
They cost. They may have decided they don't want to do that. They may have never had to do it before. So there's a variety of reasons. But effectively, what it does is it creates an opportunity because not every investor can invest in non-rated bonds. What you have to be aware of is, particularly in the Nordic space, there's a little bit less liquidity in the we're going to have to.
There's got to be some payback.
There's going to be a give, so you will definitely get a valuation pickup, pound for pound. To be fair, in the non-rated space, particularly in the Nordic high yield space, you often find the covenants are tighter. Your call protection is longer, or whatever it might be, or you have maintenance versus incurrence covenants, or all of these things. But there is a liquidity give to a certain extent, but there's a big difference between less liquid and illiquid, and this is definitely on the less liquid side.